Hi guys, Peter McKenzie here with Rincon Property Management. Today we're going to talk about how to accurately perform a break-even analysis. So we get calls a lot about whether someone thinks it's viable to rent their property out or not, and most of the time they want to know, is the rent going to cover my expenses? And unfortunately there's a little more to that, and that's what this video is going to be about, so let's get right into it. So the first thing that you have to determine is the income. How much income is the property going to produce? For a single family home or a condo, that almost 100% is coming from rent. So you got to know what the unit's going to rent for. There are plenty of resources on the internet. You can reach out to us. It's part of what we do is determining an accurate rent price. Once you know what the rent price is, then you can move on to the expenses. Now, not everybody rents a single family house out. Sometimes there are apartments, there are multiple units, and then there are, in those cases, sometimes there's other ways to generate income, whether it's storage fees, if you're charging for parking, laundry income, some people charge pet rent. There's other ways to generate income, but for the most part on a single family home, you're looking at the rent. So you determine the rent. The next thing you want to look at is your holding costs. What are the expenses of the property? The clear and obvious ones are if there's any kind of debt against the property, i.e. a mortgage, how much is the principal and interest payment? Property taxes is a pretty large expense. Insurance on the property, also an expense. Those are the ones that are kind of fixed. Hopefully they're fixed. Hopefully you have long-term 30-year fixed mortgage on the property. So you would add all those up. In addition to that, there are other operating expenses that come along with the property. Things such as fixing things when they break, other utilities. Some properties have solar, there's different ways to account for that as an expense. So those are the things that you want to be looking at. Other expenses, water softener service, if there's a pool, the pool service, gardeners. We actually like to provide gardeners for the properties we manage for other reasons outside of this video. So you want to make sure you're analyzing all the expenses. You don't leave anything out. There are other expenses that you don't have on a recurring basis. Maybe you have some legal expenses where you need some advice from your attorney, or maybe you need some tax advice, which we're going to talk about taxes here in a second. So you want to make sure you get all the expenses down on a piece of paper. There's one thing that is most often overlooked by newer investors or newer landlords, and those are the tax benefits that come along with it. So I just want to say that we are not giving tax advice. We also don't give legal advice. We're just bringing awareness to some of the most common things that are available to you as a new landlord. The biggest tax advantage is depreciation. So the IRS says you can depreciate the value of the home or the asset by 27 and a half years. There are some other rules that go along with that, but for the most part, that's the basic version of it. You can't depreciate the land, it's just the asset, so the house that's on the land. There are ways to accelerate that depreciation in the form of cost segregation studies. If you're interested in that, do a quick Google search, you can find out more about that. But as far as depreciation goes, it's not that the asset value, like what it's worth, is going down. It's the physical components that make up the asset. So the walls, the windows, the floors, the lumber that was used to create it, everything has a useful life that depreciates over time. But again, separate of what the actual property with the house itself is worth. The depreciation we're talking about is a tax theory on ways that benefit you. So the IRS says you can depreciate the asset over 27 and a half years. So let's make this easy. Let's say we have a $500,000 house that you bought. The land is worth $100,000, meaning the asset itself is worth $400,000. You would divide the $400,000 by 27 and a half years, and that would be your annual tax deduction. If you want to know what that means to your personal income, you then multiply that by your personal tax rate, which this is different for everybody depending on how much income you have. I'd say probably average for most people is between 20 and 30%. So you would multiply that annual deduction that you got from dividing the 27 and a half years by your tax rate, and that's how much you're going to save in taxes. If you wanted to get more granular, you would take that number and divide it by 12, and that's the monthly tax savings that you would get. So you want to factor that in with your income and your expense calculation, because it absolutely impacts whether or not the property is going to be positive cash flow or negative cash flow. Understand, this is a high level overlook. There are rules and things in the tax code that affect whether or not you're able to take the deduction or not. Like I said, we're not giving tax advice, but long story short, in some cases, you can take a passive loss, which is what a rental property loss is, and which depreciation falls into, and offset active income, but there is a max income that you can earn before they don't let you do that. And if they don't let you do that, then you would just roll over those passive losses till either your income comes down or you eventually sell the property. So you don't lose the benefit, you just sometimes aren't able to take it that year that you exceeded the certain income amount. Again, it can get confusing. That's not the point of this video. The point of this video is to educate you that there is some serious tax advantages. In addition to the depreciation being deductible, money you spend on property management fees, repairs, upgrades, those things also are tax deductible. The bigger, if it's a capital improvement, sometimes they make you take it over time and not all up front, but that should give you a good idea on that. So how do you do this calculation? So you take the income, let's say the income is $3,000. You take your expenses, all your expenses say are $3,000. So you're in essence breaking even. Then when you factor in your depreciation, without doing the actual calculation, let's just say that equals about $300 a month in tax savings. So instead of breaking even and not making a dime, in essence, you have a $300 a month benefit by owning the rental real estate. So I hope that makes sense on how to do the break-even analysis. It's really a simple concept. It's income minus expenses and then factor in the tax benefits, and that's all there is to it. Depending on your situation, you may be in a position where it's okay if the property is a little negative on the cash flow side, or you might be in a situation where you absolutely need positive cash flow. That is up to your own personal financial situation, and we have investors that we work with that are on both sides of that coin, and there's no wrong or right. It's just what suits you in your particular situation. The other thing I want to talk about, which is really important, which is often overlooked by the smaller investor who owns one property or maybe a couple properties, is a budget. So when you have a business or a large, 300 unit apartment complex, the people who own those generally are working off of a budget. So they would set a budget for the building and they would operate within that. X amount on advertising, X amount on repairs, X amount on payroll, those types of things. When you have let's say you own one rental property, most people aren't setting a budget. And that's a critical error, because you absolutely should be setting a budget, because it's not free to own the property. There are things that are going to come up, and you as a landlord need to prepare for them, because the idea is you want your cash flow to stay even. You don't want a lot of money coming in and then super negative another month and another positive. Like, you don't want that. That's bad. So how do you do that? It's a very simple equation. What we tell our clients is they should be saving 5% of the gross rents on repairs. This is to fix things that break. This isn't necessarily replacing big ticket items. This is, there's a leaky faucet, a handyman comes and repairs the leak. 5% of the gross rents need to be saved for repairs. Now, in a perfect world, you wouldn't spend all that 5%, but I'm here to tell you that eventually you will, because everything breaks eventually. So 5% for repairs. The next one we like to advise people to save for is for capital improvements, or CapEx, some people call it. This is replacing big ticket items like the windows, the flooring, the HVAC system. Anything that's big and adds value to the property falls under these CapEx. There's two numbers that we advise our clients. If the property is in an HOA or a condo where the homeowners association is responsible for some of the big ticket items, like the roof is owned by the HOA, or they cover anything in the exterior walls or the common areas, You as the investor have to save less because you're not responsible for some of those big ticket items. Now the HOA is absolutely budgeting for those things and they get those funds from the HOA fees. So if your property's in an HOA, we advise about 5% of the gross rents goes towards capital improvements because you still are responsible for things, whether it's, the heater or the water heater, those type of things would fall under capital improvements. We like you to save 5%. If it's not in an HOA, if it's a standalone single family house or, duplex, triplex, we like to say you should be saving 10% of the gross rents for capital improvements because you're responsible for more things than you would be in an HOA environment. So the last thing we like you to budget for is vacancy. Now, vacancy is different all across the country. In some areas, vacancy is high, in some areas, vacancy is low. We happen to be in an area where there is a low rental inventory. And we know how long it takes us to fill our properties because we track all that data. So in our area, we don't have enough rental properties. So when one comes available, people are generally competing over getting it. What that means for you as the landlord is you have to save less for vacancy versus if you had an apartment building in an inner city where half the units were vacant and there was a lot of problems, it would be a totally different calculation that you need to save for. So for our clients, we recommend you save about 2% of the gross income for vacancy because you will eventually experience a vacancy. It's guaranteed. No one stays in a property forever. So when the property eventually turns over, you are going to experience some time that you're not collecting rent when the property is vacant. That's when you would go to this vacancy fund that you've been saving and you would extract the funds there to keep your cash flow even during the vacancy. In our particular company, we run a little under 20 days of vacancy between tenants. So you would know that, if you had to cover 60% of the month for vacancy, your rent is X, it's a very easy calculation to do. Now, so you should be saving for those three things: repairs, capital improvements, and vacancy. Eventually, you're going to build up enough of a reserve fund to where you can withstand anything that the property throws at you, whether it's a small repair, large repair, a vacancy, whatever it is. If you do the budget, it will make your experience as a landlord better. If you don't budget and there's no money in reserves, that's when you see landlords getting into trouble, which is not where we want you or any of our clients to be. So I hope that makes sense. Hope this information helps you do an accurate break-even analysis. You'll see this process called other things. It just doesn't have one name. Different people call it different things. But in essence, you're trying to figure out, does this make sense to rent? Am I going to go broke by renting this property, or am I going to make some money? And almost always the advantages, in my opinion, outweigh the negatives. Not in every situation, but for the most part. Hope that makes sense. If you like this content, please subscribe to our YouTube page. Fill out the contact form on our website. We're happy to have these conversations. And this is a common conversation we have with people who are new at this, which we're happy to have. Thank you.